Well, I'm not going to talk to you about value. Sorry. I'm going to talk to you a bit about what's going on elsewhere. The US market is, as Kim was saying, a very high share of the MSCI world market. As Georg was telling you, the US market is extremely concentrated today, and it's concentrated in the theme of artificial intelligence. Goldman, at the end of April, estimated that 45% of the US market is AI-related theme. This is not just a US market story. The emerging markets now are increasingly tied up with the AI theme. You take TSMC's, Samsung, and SK Hynix. And the computer hardware, semiconductors, as a share of emerging markets have gone from something like 23 to 43% of emerging over the last year, or at least until the semiconductor sell-off a few days ago. So really, if you're not buying value, you're buying something else. You're buying into the AI story. And what I'm going to talk to you briefly about now is how markets have responded to earlier new technologies over the past 200 years. And what I'm going to show you is that there's a common pattern at the inception of groundbreaking new technologies that doesn't really change that much. I wrote a paper earlier this year with my former boss, Jeremy Grantham, from which this presentation is taken. So you can find that on the GMO website. I also recommend a book by the former head of research at Templeton called Alistair Nairn, and it's a book called Engines That Move Markets. It came out in 2003, and I found it a very useful way of looking at this history. And I wrote a history of financial speculation called Devil Take the Hindmost. Came out in '99, which I'm currently updating. Anyhow, so let's cut to the chase. So how does it start? Well, what happens is there is an emergence of a new technology that attracts excitement. And as Bill Bernstein, the author of a book called The Delusions of Crowds, that came out a few years ago, says that narratives are the pathogens that spread the bubble disease throughout a society. It helps that the new technologies, railways in the 19th century and telegraphs in the 19th century, telephones and wireless in the 1920s, and the internet in the 1990s, both serve as the object of speculations and the medium for spreading the speculative further. So what do we have today? We have the greatest technological narrative that has ever appeared. I repeat that, the greatest, most extreme narrative. Well, bigger than the invention of the steam engine, more significant than the invention of fire. A technology that within a short period of time will be forging the scientific breakthroughs that only Nobel Prize winners can achieve, that will be rewriting the works of Shakespeare, that will be driving GDP growth so that it doubles every few years, so that none of us will ever need to work again. A new era for humanity. Look, I read the history of financial manias. I've read what happens with, the excitement that attracted to the railway when they came out in the 1840s. They talked about world unification, peace. Exactly the same language was used about the telephones, and likewise about the radio. Nikola Tesla thought that with the radio, the world would come together and operate with one mind. Many of you here will remember similar types of stories told about the internet during the internet boom. I'm not saying that these technologies didn't transform the world. They clearly did. But they came against, at the outset, a frenzied attraction. And here the chart shows this conception that we are on the verge of singularity, where the machine intelligence exceeds that of mankind. Again, normally in the history of technological financial manias, they normally occur against the background of easy money. This chart shows you the interest rates in the 1840s that went down to 2%, just as the great railway mania of Britain was taking off. And it was the great English financial writer Walter Bagehot who constantly went on about the fact that when interest rates fell to 2%, investors would do crazy things. Now, we clearly saw that in the late 1990s, beginning of the Greenspan put, if you remember, after the LTCM fiasco. We saw it in the early 2000s during the credit boom when interest rates were taken down. And we saw it in spades in the last decades and the first part of this decade with interest rates kept at zero and trillions of dollars of quantitative easing. Now, interest rates have risen since 2022, but there was a great deal of liquidity that remained in the system from the long period of quantitative easing, and monetary conditions, as you can see from this chart, which just shows US bank credit growth, have remained relatively loose. The essence of a mania obviously lies in general investor enthusiasm or optimism. And here I show you a picture of a satirical print of John Law's Mississippi bubble of 1720, of a frenzied crowd in the Rue Quincampoix, which is the open-air market in Paris, where stocks were traded. We find whole communities suddenly fix their minds upon one object and go mad in its pursuit, wrote Charles Mackay in Extraordinary Popular Delusions and the Madness of Crowds, 1841. A couple of years later, Mackay was actually buying railway stocks, which turned out to be a bad bet. But these compelling narratives corrode the analytical process, and dissonant voices are met with, dissonant voices are ignored, and skeptics are met with vehement criticism. Their warnings attract scorn and ridicule. What about today? So today, I am saying, is the most speculative market we have seen at any time in history. It is so speculative that we are numbed to how speculative it is. We live in a world of virtual assets, of assets not supported by anything, of which cryptocurrencies are the very essence. But we live in a world, and here the chart shows you the average trading, high turnover of a retail cash in the US stock market. We live in a world in which, particularly in the US, in which retail investors are playing a dominant role. The world of zero commission trading, the world of Robinhood, of the Robinhood app. Robinhood is again, I don't want to use hyperboles the whole time, but it is a tool for gaming and speculation that attracts tens of millions of investors. We have a proliferation of ETFs. There are more ETFs than stocks nowadays. Many of these ETFs are leveraged. You can get 2 times NVIDIA, single stock, leveraged ETFs. You can get MicroStrategy, leveraged ETFs. Most of the trading on in stock options today is in single day stock options, 60% of turnover. New York Stock Exchange margin debt is at a record high. I won't go on, because I could go on about that all day. Another feature of the boom is a wave of new publications promoting the merits of a new technology. In the railway boom of the 1840s, new railway papers were appearing every week. Many of them published twice a week, some published daily. The Economist and the Times of London added extensive railway supplements to their journals. At the end of the 19th century, there was a plethora of publications about motorcar technologies. You'll remember, some of you remember, the publications that accompanied the internet boom of the 1990s. Here I show you the cover of one, Industry Standard, that I used to write an occasional column for. Didn't live long. But there were a number of others, Wired, Fast Company, that sort of thing. Today, we don't really need magazines. There are online magazines like The Information that writes daily about AI, and actually is very high quality analysis of what's going on. We are wherever you look, there is AI. There's AI, obviously, on the social networks, on X, on TikTok. There are AI podcasts. The AI dominates. It dominates the Google search terms. There is a preprint academic online portal called Archive. Apparently, it publishes 100 papers a day on AI. No doubt many of those papers are written, in fact, by AI. There is no shortage. We are drowning in information. Very important feature of the boom is an efficient and productive supply machine capable of creating a host of new companies to meet investor demand. A shorter way of saying that is the Wall Street adage, when the ducks quack, feed them. In 1720, during the South Sea bubble, 200 companies sprung up, the so-called bubble companies, of which the most notorious was a company of great advantage, but no one to know what it is. Of those bubble companies, two bubble companies survived. During the railway mania, there were hundreds of railway companies that were launched. Again, going back, I highlight here the IPOs of 2000. You see there, and then the SPAC, the notorious SPAC boom of 2020-21. But as I say, we're doing things bigger and better today. There's a Goldman's chart recently showing the expected IPO proceeds in the pipeline this year. Three companies, SpaceX, Anthropic, and OpenAI, if OpenAI actually gets to market, which is a big question mark, would actually account for raising more capital than the entire TMT boom. And those of us who lived through the TMT boom and got those, those endless, bloated brokers' IPO prospectuses with the most intolerable nonsense in them, can hardly believe that we have come back to see the same again. And as Alex was telling you about SpaceX, a company that's going to transform humanity, to conquer the universe for mankind. I mean, it is not just the most overvalued. If one can't even really talk about valuation, a loss-making business with a 1.75 trillion valuation, raising a record amount of capital. But it's not really just in the IPOs. So, quietly, Google slipped out, or Alphabet slipped out, 84 billion or 85 billion secondary issuance. And in case you didn't notice, earlier in the year, Alphabet was issuing 100-year bonds. So it's raised another 80 billion from the debt capital markets. And if you look at this chart from Torsten's Lock of Apollo, I had the earlier part of this presentation, which I was showing last year, sort of earlier version, and it had venture capital share of AI at 67% last year, which seemed high to me, except Slock's updated it, says that venture capital is now 87% of AI. And AI is now nearly 50% of investment-grade debt issuance. I understand that this year, every month this year, has been a record level of investment-grade debt issuance, of which driven by the increasing share of AI in the debt issuance, and high yield down at a measly 38% AI exposure. And that's not all, because the entire structure of modern finance has come to push the AI theme. And so we have SPVs being used to finance the data centers and private credit and so forth. The suspension of normal and other suspension of normal valuation criteria. Alex showed you this chart, which was stolen from the presentation, the paper that I did with Jeremy earlier in the year. Fair enough. And what we, I think my former Urban and my former colleague Beninka showed that when the stocks that trade on over 10 times sales deliver, I think, something like 2% returns, so sort of roughly less than a third of the average market level. But here you have, and then more commonly people use the cyclically adjusted price earnings ratio, which went averaged just under 18 times since 1880, peaked at roughly 33 times in 1929, 44 times in early 2000, and around 40 times when I last looked. But I want you to stick with the price to sales ratio here, and that's for the whole market, not just the share trading at 10 times sale. So here you see on this measure the price to sales ratio of the US market is at its highest level ever, exceeding the everything bubble period of 2020-21 and far exceeding the dot-com peak of 99-2000. And why I think this measure is most important is that US profits are currently highly inflated or bloated. And what that means is that we're having a high valuation of the market on top of high reported profitability, which is what my old boss Jeremy Grantham calls barbaric double counting, because in an efficient market, we should have a low multiple on high profits and a high multiple on low profits. I think one of the things that distinguishes the bubble today, and Georg and I were talking about it last night when he said, these stocks are not, some of these big stocks are not that expensive. They're not optically expensive on a price-earnings ratio, or not optically very expensive on a price-earnings ratio, but the profit margins today are much higher than they were in 2000. And that's clearly the case. You see what's happened, say, to the semiconductor stocks, which have profits now up in sort of 80 to 90% range from, which is something, let's say, something like 4 times their average range. So this is I like to call it a fundamental bubble as much as it is a valuation bubble. It is not always the case, but sometimes the case that when the technology arrives, it's not quite mature. And I'm showing you here is a picture of the carbon arc lamps technology that came in the early 1880s, attracted a lot of attention, but the trouble was they worked, they were going to be used for public lighting, but they were expensive. They were more expensive than gas lighting, and they were later superseded by Edison's incandescent light bulb. And although Edison was a critic of the carbon arc lamps, he hadn't actually developed the technology to get his incandescent light bulbs to work at the time. Now, I'm saying this is not always a feature of the inception of the new bubble, but it is often the feature. The other thing we should say about the inception of new technology, it's not clear always clear which technology is going to win. For instance, in the 1990s, with the new automobiles, there were steam engine technology, steamers, electric, supported by Edison, and the internal combustion engine. Well, electric and steamers far outsold internal combustion engine in the 1990s. I think the first stock to list, automobile stock to list in the States, was an electric vehicle. It turned out the electric vehicles didn't have range and were expensive, so exact same problems they have today. Now, I'm going to maintain, and this gets a bit contentious, that the large language models are an immature technology. They are questions about, I'm not saying that they aren't marvelous, but there are questions about their reliability to the nth degree. And the question of whether the hallucinations, the tendency to come up with wrong answers to bullshit, is an inherent part of the technology. I don't know. But what I do know is if you keep an eye out, despite the great advances that are going on almost on a monthly basis with the frontier models, they are still hallucinating. Just read the newspapers closely. You will see stories. I mean, the other day, Sullivan and Cromwell, large top US corporate law firm, had to apologize to a US bankruptcy judge for including in its filings hallucinated material from some intern who no doubt got the sack. So you've got the Claude codex, the advance in vibe coding. There was a story a month or so ago of a company that provided software for car rental companies, which used vibe coding, used the latest Claude model, and it wiped out its entire customer database. So I'm going to suggest well, Amazon, I don't know, Amazon took down its own Amazon Web Services after some of its guys had been vibe coding. So I'm saying there's a question mark that remains over this technology. There are little bugs that remain that have to be ironed out. And that's just part of the story. We don't know what type of artificial intelligence model will predominate. Will they be these frontier models run on the giant, in these giant data centers, incredibly capital intensive, energy intensive business? Will they be more the open source model? Turns out to be a lot cheaper that the Chinese are offering. Or will they be these small language models that can actually run on Apple computers and may be running on your phone? I don't know. Nobody knows. But we're making very big bets as if we do know. A huge overcommitment of capital forcing down potential rates of return. On the left-hand side, you see the British Railway capital invested in the in railways. The first railway came out actually in Britain in 1825. Little sort of boom of investment in the mid-1830s, and then a huge surge of investment in the 1840s. And this is really the greatest investment boom relative to GDP that ever happened. There were, I think by 1847, 7% of GDP was being directed into investment in new railway stock. And there you see the movement of the share price, which follows, well, it actually precedes the investment boom. And the upshot of that was massive overinvestment in railways. So I like to say there were 3 railway lines running between London and Peterborough in East Anglia, 3 railway lines running between Leeds and Manchester. And I saw the other day that actually if you'd invest, the transportation technology knocked out by the railways was obviously the canals. But if you'd invested in canals in 1845 and held your canal investments till 1850, you'd have made money, or at least not have lost as much money as the 65% fall in the UK, the British railway market. And here you see the TMT investment, the sort of Tobin's Q relative to the US investment to GDP. If you remember, massive over-investment in fiber optic cables, which I think, say, in the range of overcapacity, ending up about 95 to 98%. And what's interesting about that one, I can't go on too long, is that there's a guy called Andrew Odzliko who was working at Bell Labs at the time who pointed out that the market narrative of data traffic doubling every 2 months was false, that data traffic was only doubling once every 6 months, and the upshot was that over the course of the year, that's a 12-fold exaggeration. We could have told, or we knew, if anyone cared to pay attention, that the narrative of growth that was driving the investment was false. Today, capital spending in AI is going hyperbolic, and it just keeps on, you can't make a presentation on AI because you have to redo everything every few weeks because everything gets bigger and bigger. So this is Gerard Minack, who used to be the strategist at Morgan Stanley, and he shows it there, the sell-side forecast for the hyperscalers investment from July of last year at sort of 450 million, going out to 27, and then jumping up this year, updated to over 900 billion. And I think JP Morgan has an estimate for next year of 1.3 trillion of AI investment, and that's just the listed companies. And the perception among the players is, and this is put by Mark Zuckerberg at Meta, is that it doesn't matter if we lose a couple of 100 billion on this investment, or as the Alphabet CEO said, the risk of underinvesting is dramatically greater than the risk of overinvesting. And I used to think that they were really caught in a prisoner's dilemma, where one person was moving, others had to follow. But now I actually think that there is this theory of mimetic desire from the French social theorist René Girard, in which human beings are wired to imitate and copy each other. And I think in Silicon Valley, that highly competitive place, mimetic desire may be driving this investment as much, if not more so, than actually a prisoner's dilemma. They all want to be the first to get to AGI. They don't want to fail. And if they take down their companies, they're not going to take down their companies. But even if they were to take down their companies, it'd be a small price to pay. Unscrupulous and fraudulent behavior, what J.K. Galbraith called the bezel, the inventory of embezzlement within the financial system. A bubble, the original meaning of the word bubble, is a fraud. That's what the South Sea bubble was. It's the South Sea fraud. Every single bubble contains a large element of fraud. Where is the AI bezel today? I can't tell you for sure because the bezel only becomes clear after the bust. That's its nature. But I think we can see the outlines of it in the sort of house of cards of commitments of capital flowing from businesses in the AI environment, in which there are now, I think, again, it sounds like a large number, but I read it again this morning. There are $1.5 trillion of pre-commitments off balance sheet in the AI universe. And there is this vendor financing in which companies are, like NVIDIA at the core, or the hyperscalers are lending money, or the hyperscalers investing in the frontier model makers and generating profits from these investments, which, as we saw in the with the telecoms equipment makers in the 1990s, didn't pay off. There's also a problem with the depreciation rates used on the GPUs. They've extended them from, in general, hyperscalers from 3 years ago to 5.5 years today, and CoreWeave is out at 16 years, apparently, on its GPUs, while heavily selling insiders' stock. Eventually, you get to the shakeout, and the point about the shakeout, I think there are severe shakeouts whenever there are high amounts of competition among a new technology. I think the only exception I can find, to my recall, is that because I think that the Bell telephone system had pretty good patents and pretty good monopoly, and therefore was able to establish itself without a huge shakeout. But in general, the new technology should be a large number of competitive players in which one or two will emerge dominant. This is clearly, there is no doubt about it, this is clearly an intensely competitive market, and I think very unlikely that there will be, I'd put it differently, very, very likely there'll be a severe shakeout. And if you want to invest in this stuff, by and large, the time to invest is in the during the shakeout phase rather than today. So what can we see today? The capital investing entering the AI space exceeds TMT, investment turn a century. The risks elevated by growing amounts of debt. Question marks remain about the large language models. Based on past precedents, from the railway mania onwards, this certainly looks, to my mind, like a bubble. As I said, nearly half the market, US market exposed, and that makes for sort of roughly 1/3 of the MSCI ACWI market. US stock market, by many evaluations, most expensive in history. This time may be different. Never is.